I get the feeling that the dust is settling on the entire reopening narrative and what it means for positioning in Chinese assets. How do we approach the market?
Well, it's a great and involved question, Sri. So let me just unpack that a little bit. I'd say what do we think is happening fundamentally? How has the market performed, and where are investors positioned? So in terms of what's happening fundamentally, we've become increasingly constructive in terms of both the economic growth outlook and, more importantly, the corporate earnings outlook for the stock market. Super quick, we raised our GDP forecast twice from 4.5 to 5.2 and then 5.5 for 2023, and our earnings even more from 8% to 13 to 17. So in terms of the broader China index, we think that the earnings growth this year will be pretty much the best in the region, with the exception of Hong Kong, which is having a recovery from a depressed base. So fundamentally, think things are good. And with the market having rallied very significantly, valuations have improved, but off a very, very low base. So the low was 8.2 times earnings back in early November. We're now trading around 11 times earnings, but that's still quite reasonable, we think, relative to the overall historical range, and even assuming there might be some further discount for various risks, which investors are well aware of. So our simple arithmetic is that if we've got kind of 17% earnings growth, and we've got some potential further valuation improvement, we think we can see high teens returns from here over a 12-month view. So we're still very constructive. Now, that being said, we have to remember that the market just had a very significant rally off the low, about 60% up off the lows. It's pulled back a bit. So, there's a bit of digestion going on, but I've literally just been around the world talking to investors, and I think that not everyone who could be in the trade is in the trade, and therefore, after we get a bit of profit taking from the fast money, we think that there'll be another leg up. So our bottom line is we think there's further to go.
Oh, that's interesting. So international portfolio investors still remain relatively underinvested in China, and they haven't yet fully jumped onto the China bandwagon. So if valuations remain compelling, do they remain compelling in the China internet names, Tim? Is that what you want to own under this reopening scenario?
I mean, that is one of the areas that we do like. And I just want to pick up on your characterization of the China reopening, because we think a better way of characterizing China is actually a growth recovery trade, not just a reopening trade. The reason being, if it was just reopening, you'd really be focusing on consumer and services, because those are most affected by the lockdown. But if it's a broader policy accommodation supporting growth, then that gives you room to invest in other parts of the market, including the internet names, which you just mentioned.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen, and don't forget to subscribe to the channel for more. Thanks for watching.